Hello everyone and welcome to week 6. This week we're talking about capital investments and the capital budgeting process. The focus of this chapter is on how companies make financial capital investment decisions. The process of making capital investment decisions is often referred to as capital budgeting, which is planning for investments in long-term assets in a way that returns the most profitability for the company. Capital budgeting is critical to the business because these investments affect operations for many years and usually require large sums of cash. Previously, when you learned how to complete the master budget, we discussed budgeting objectives to develop strategy, plan, act, and control. The same objectives apply to capital budgeting, but the planning process is more involved due to the long-term nature of the asset. Exhibit 26-1 illustrates the capital budgeting process. The first step in the capital budgeting process is to develop strategies. These are the long-term goals of the business, such as expanding international operations or being a value leader in one market while diversifying into other markets. This step is the same for short-term, intermediate, and long-term budgeting. After companies develop strategies, the next steps are to plan and budget for specific actions to achieve those goals. The second step in the capital budgeting process is the planning process, which has 3 sub-steps. The first is to identify potential capital investments, for example, new technology and equipment that may make the company more efficient, competitive, or profitable. After identifying potential capital investments, the second sub-step is to analyze the investments using one or more capital budgeting methods. The fourth step in the budgeting process is control. In the short-term operational budgeting process, the control step is called variance analysis. After acquiring and using the capital assets, the companies compare the actual results from the investments to the projected results. The comparisons are called post-audits, and they help companies determine whether the investments are going as planned and deserve continued support, or whether they should abandon the project and dispose of the assets. Notice in Exhibit 26-1 that the control step loops back to the first step. Develop strategies. The post-audit helps managers learn from their decisions and make adjustments as needed. The adjustments are then considered when developing new strategies. The analysis of capital investment sometimes involves a 2-stage process. In the first stage, managers screen the potential capital investments using one or both of the methods that do not incorporate the time value of money, which are payback and accounting rate of return. These simple methods quickly weed out undesirable investments. Potential capital investments that pass stage 1 go on to the second stage of analysis. In the second stage, the managers further analyze the potential investments using the net present value and other internal rate of return methods. Because these methods consider the time value of money, they provide more accurate information about the potential investment's profitability. Some companies can pursue all of the potential investments that meet or exceed their decision criteria. However, because of limited resources, most companies must engage in capital rationing, which is the third subset of the planning process. Capital rationing is the process of ranking and choosing among alternative capital investments based on the availability of funds. Managers have to determine if and when to make specific capital investments, so capital rationing occurs when the company has limited cash available to invest in long-term assets. In the fourth subset, companies compare the actual results from the investment to the projected results. The post-audit is the comparison of the actual results of the capital investments to the projected results. Step 2 in the capital budgeting process involves analyzing the investments using one or more capital budgeting methods. In this chapter, we discuss 4 popular methods of analyzing potential capital investments: the payback method, the accounting rate of return, net present value, and internal rate of return. The first 2 methods, payback and accounting rate of return, are fairly quick and easy, and they work well for capital investments that have a relatively short lifespan, such as computer equipment and software that may have a useful life of only 3 to 5 years. Payback and accounting rate of return are also used to screen potential investments from those that are less desirable. Payback provides management with valuable information on how fast the cash invested will be recouped. The accounting rate of return shows the effect of the investment on the company's accrual-based income. However, these 2 methods are inadequate if the capital investments have a longer lifespan, because these methods do not consider the time value of money. The last 2 methods, net present value and internal rate of return, factor in the time value of money, so they're more appropriate for longer-term capital investments. Management often will use a combination of methods to make final capital investment decisions. Capital budgeting is not an exact science, although the calculations on these methods they may appear to be precise. Just remember that they are based on estimates or predictions about an uncertain future. These estimates must consider many unknown factors, such as changing consumer preferences, competition, the state of the economy, and government regulations. This makes long-term decisions riskier than short-term decisions. The analysis of capital investments sometimes involves a 2-stage process. In the first stage, managers screen the potential capital investments using one or both of the methods that do not incorporate the time value of money, payback, and accounting rate of return. These simple methods quickly weed out undesirable methods or investments. Potential capital investments that pass stage 1 go on to the second stage of the analysis. In the second stage, managers further analyze the potential investments using the net present value or the internal rate of return method. Because these methods consider the time value of money, they provide more accurate information about the potential investment's profitability. Exhibit 26-2 summarizes the common cash flows and outflows from capital investments. Generally accepted accounting principles, or GAAP, are based on accrual accounting, but capital budgeting focuses on cash flows. The desirability of a capital asset depends on its ability to generate net cash inflows. That is, cash inflows that are more than cash outflows over the asset's useful life. Recall that operating income based on accrual accounting contains non-cash expenses, such as depreciation and bad debt expense. These expenses decrease operating income, but they don't require a cash outlay. The capital investment's net cash inflows, therefore, will differ from its operating income. Of the 4 capital budgeting methods covered in this chapter, only the accounting rate of return method uses accrual-based accounting income. The other 3 methods use the investment's projected net cash inflows. Exhibit 26-3 illustrates the life cycle of capital investments with the timeline representing multiple years. Cash inflows include future cash revenue generated from the investment, any future savings and ongoing cash operating costs resulting from the investment, and any future residual value of the asset. Cash inflows are projected by employees from production, marketing, materials management, accounting, and other departments to aid managers in estimating the projected cash flows. Good estimates are a critical part of making the best decisions. To determine an investment's net cash inflows, the inflows are netted against the investment's future cash outflows, such as the investment's ongoing cash operating costs and cash paid for refurbishment, repairs, and maintenance cost. The initial investment itself is also a significant cash outflow. However, in our calculations, we will always consider the amount of the investment separately from all the other cash flows related to the investment. The projected net cash inflows are given in our examples and in the assignment material. In reality, much of the capital investment analysis revolves around projecting these figures as accurately as possible using input from employees throughout the organization, people from production, from marketing, from all over, and it would depend on the type of capital investment. Thanks for watching the video. I'm going to post this in the discussion with a follow-up question, and I will see you there.